So we finished that one, I believe, right? We finished on I could really pocket the owner earnings, and we talked a bunch about that, and you decided to delete it. And that was the last one, right?
Yeah. Yeah, that'd work. That's it.
That'll work. Okay.
And let's go on to the next method of valuation. So to make a point here about 10cap doesn't value the business, it prices it. In other words, it says, I don't know what this thing is worth, because knowing what a business is worth is a real questionable enterprise in terms of knowing with any level of certainty at all that you could decide, oh, this is worth X. Rather, we use a method that says, I don't know exactly what it's worth, but it's worth a lot more than I'm paying for it if I can get a 10% yield on the owner earnings of the business. And that means even if the business doesn't grow, I'm getting a benefit, right? In other words, if I'm the owner of this business, this house that I own, I'm getting the benefit in terms of cash flow at 10% yield. Even if I can't raise the rents, that's an okay place to sit with our money. So the downside here is fairly limited, right? And the upside is that, wow, the community might just really get valuable. And this thing, we could increase rents on it, plus the value of the business would increase with that. So that's the essence of the theory of the 10 cap. This method is called Payback Time. I wrote a whole book about it called Payback Time. That is really just the story of figuring out the price you want to pay for a business based on what private equity does, what we do without a public market. How much would you pay for a business aside from the public market? And it turns out that private businesses' average purchase price is about 7.5 times their earnings. Okay, so about 7.5 times the earnings of a company, and you end up with a private business. Now, I'm going to hear a lot from people that are going, that's way too high, that I bought a private business for 3 times earnings or 2 times earnings. Yeah, and little tiny businesses can go for a huge range, really across the board. But if you're talking about a business that's fairly substantial,
I've bought and sold businesses at 12x, 13x, 14x. So it just depends on the kind of business.
Yeah, exactly. And one of my brothers sold his business at 9.1x, right? And it was a sizable business, multi-million-dollar company. So there's a big range here, but in general, the average is about 7.5 ballpark, a PE ratio of 7.5, and that compares to a public stock PE ratio of 15 average. So over the last 140 years. So that means
not so much
essentially
these days.
Right. These days are much more expensive. But that basically says that roughly speaking, a private business is selling for about half of what a public business is selling for. And that's essentially where the number comes from when Charlie and Warren are talking about a margin of safety. They're talking about essentially paying a private business price for a public business. And that makes sense for them because they really don't care about the liquidity that is provided by a public business. That's not something they care at all about. So they don't want to pay a price for that. Not only that, but buying the company at a private price accounts for a lot of vicissitudes of life, because if we're buying a private company, we're stuck with it. You can't just unload it the next day any more than you could buy a house and sell it the next day. You're going to take a loss if you do that. So we really like this method of finding a price to pay for the company. So you ready to jump into it?
Yeah, I want to hear the list.
Here we are. It starts off with the very difficult thing, which is I am confident in the long-term growth rate of earnings for this business.
I am confident in the long term.
In other words, I feel like I know it well enough that I can project a reasonable long-term growth rate here for this company. So if I'm buying a private company
I am confident in the long-term growth rate of this company. That's it?
Right. Okay. Yeah, that's the first one. So, think about it. If you were to buy a house you would probably have a pretty high degree of confidence in your ability to raise rents over time, right? I mean, you could look and see, well, what have rents been raised over the last 20 years in this area, And are we getting a hotter market or a colder market? So you could make a reasonable guess. That's all we're asking for here is a reasonable guess. And we do that with a combination of knowing the business historically, which is what all our numbers are all about that we've talked about, and also looking out into the future. Where's this going? Where's the industry going? Where's this business going in terms of its position in the industry? And making a projection. Where am I at with this? So if it's too hard to do that, then move to another business. This is a really good place to take a deep breath and say, am I really comfortable that I understand this business well enough to do this particular checkbox? And I got to tell you, you need to have simple and predictable businesses. That's just honestly so fundamental to doing this right.
Yeah, picking a growth rate is it's a more of an art than a science, I would say. Would you agree with that?
Certainly is. I mean, yeah, it certainly is. Well, I would say you want to make it as scientific as possible, right? By looking. But
at the same time, remembering this is the future in which all vicissitudes could happen.
Exactly. So you basically say, okay, this company has been growing at, let's say a really fast growing company. It's been growing at 19% a year.
Okay.
Year after year after year after year. And it's 12 years old. And there's no upper limit within sight in the next 10 years. In other words, the industry can support this company continuing to grow at 19% a year, right? Mm-hmm. And the method of them growing at 19% a year is build new stores. And those stores pay for themselves very quickly, 4-year payout, and you've understood the business and you realize there's no limit in the next decade for what they can do at the rate that they're going. So let's say the rate they're going is to build 100 new stores a year. They can continue that rate at least for the next 10 to 15 years. No question about it.
Cool.
Given the size of their industry, right?
Okay.
So you could have a pretty decent guess that this is going to continue rocking at that rate, right?
Yeah.
So that's how you do it. All right. So that happens to be check point number 2.
Then what I would do is say, well, that all seems really reasonable at 19% per year. I feel very good about that number, and now I'm going to knock it down to 15% because I'm afraid of things showing up.
There you go. You could do that. You could do that, and you'd be
That's what I
maybe
always
more
do.
Conservative. I know it's not stupid, but the second thing on our list here is there's no ceiling to this level of growth. So whatever growth rate I pick, I need to make sure that for at least the next 15 years, this can't limit out based on the size of the industry, the amount of competition in the industry, the number of stores that you could possibly have out there. In other words, don't be projecting that you can put 10,000 restaurants out there if that simply won't occur, if that's not possible. If you look at other competitive places, and say, okay, well, Olive Garden doesn't have 10,000 restaurants out there, right?
Yeah.
You just can't.
Okay,
And
so there is no ceiling on this level of growth is the next one.
Right.
Okay.
To this level of growth.
And when you say
for
this
at least
level
15 years.
And when you say this level of growth, do you mean the growth rate that you've chosen, or do you mean like a 3-year trailing
the
growth
one I
rate?
chose.
Okay.
So if I'm putting 19% on this company, I've got to say, okay, no ceiling here.
Yeah.
They can do that for the next 15 years.
Yeah. Okay.
And the reason I'm saying 15 years, honey, is because I want to make sure that in my theoretical point where I'm going to sell this business, which we'll say is 10 years from now. I actually would love to never sell it, but let's just put a number on it. We're going to go 10 years.
Mm-hmm.
In order to sell it for the PE ratio that I'm going to put on here, for the multiple of earnings, then I need to know that level is going to continue for years after that.
Mm-hmm.
And so that's where you go, okay, we're going to sell it in 10, but it's going to be sold to somebody that thinks it's going to keep doing that for at least another 5.
Totally.
Okay.
Okay.
Cool. You guys, if you enjoyed this video and you feel it was valuable in teaching you more about how to invest, hit the like button and please share the video with your friends. And if you want more investing content, subscribe to my channel. And don't forget to click the button on the screen. We got a free gift for you. Thanks again for watching.